In today's video, we'll do an in-depth analysis of Coca Cola stock. We'll determine if now is a favorable time to buy based on business operations, fundamental, and technical metrics. Now we'll dive into Coke's business operations by segment and geography to determine how and where they generate revenue. Coca-Cola breaks down their revenue in a few different categories, one of them being by beverage operations, which is separated into concentrates and finished products. 56% of revenue comes from concentrates and 44% of revenue is from finished products. Their concentrates are sold to retailers who sell their beverages in places like restaurants as fountain drinks, and their finished products are sold at places like convenience and grocery stores, although convenience stores also sell concentrate products. Being that Coke has many subsidiaries, the next way they break down their revenue is by region and by their subsidiaries. Europe, Middle East, and Africa makes up 16% of their revenue. Latin America makes up 11.4%. North America, being their primary business, makes up 36.5%, and Asia Pacific makes up 11%. Then they have subsidiary segments titled Global Ventures, which is made up of Costa Coffee, Monster Energy, Indocet, and Dogadan. And lastly, they have their bottling investments, which are company-owned bottling operations. If we compare this to their net income by segment, we can see that their Global Ventures and bottling investments contribute significantly less income compared to the other segments as a proportion of revenue. Now let's cover the macro level benefits or pros of buying into Coke. I think some people may overlook this aspect of Coca-Cola, but one of the major reasons why they've stood the test of time is that they sell many products that contain an addictive substance, caffeine, which transitioned from their previously addictive substance, which is in their company name. Addictive products lead to return to consumers. If you're familiar with the dividend kings, you'll probably know that Coke is one of them, which is emblematic of the power of addictive substance and how it can withstand severe economic downturns. As I was browsing Coke's website, though, I found this, where they seem to negate the addictive power of caffeine and state that the purpose is for great taste. It seems suspicious to me. On that note, another more subtle way they keep the consumer hooked is through their packaging. Their products are sold in bite-sized consumables that are consumed habitually. This keeps the consumer tied to a product, which creates a consumption habit. Think of this like another product that has the same packaging model. Another benefit is that they sell drinks, which require minimal commitment from the consumer, meaning the mental barrier to purchase is lower comparatively to something like a snack. On the topic of selling drinks, they're a very high-margin business, as most of their drinks are essentially flavored water for a high price, bottled in plastic. This is probably yet another reason why they've stood the test of time. Another prominent benefit is that they are omnipresent across the globe and offer around 3,500 different products. Basically, anywhere you are in the world, you can buy a Coke product, except here. This leads me to another point, which is through buying Coca-Cola stock, you get the pride of ownership and you can see your products consumed as you walk about the world. Better yet, they sell beverages in so many categories like juices, energy drinks, coffee, and alcohol, just to name a few. And supposedly, they serve 1.9 billion consumers daily. Yet another great benefit to Coca-Cola is that the beverage space has very few large-scale competitors. And if the competitors get too large, Coca-Cola can buy them out, which it has done with so many brands throughout time. Now we'll look into the macro-level cons or potential risks of buying into Coke. The first one that comes to my mind is growing health trends that are attempting to move away from sugary drinks. Coke sells products that are generally consumed for enjoyment and are non-essential. But these health trends don't just influence the consumer, they also influence policy. In some places, sugary drinks are taxed like we see here, and their marketing, labeling, and packaging are regulated due to the health risk of obesity and sugar being determined as a contributor, which Coke recognizes as risks to their business in their annual report. I even found a scientific paper that depicted how Coke attempted to redirect causes of obesity away from sugary drinks and towards a lack of exercise. So Coke must see this as a real risk as well. In contradiction to all this social buzz about health trends and contributing factors, obesity is still steadily rising in Coke's biggest market, which is the US. So this could be thought of as a tailwind for shareholders. Additionally, 68% of their beverage portfolio contains less than 100 calories per 12-ounce serving. A few more high-level risks to Coca-Cola are over environmental concerns regarding water scarcity and climate change reducing agricultural yields, which Coke references in their annual report. Although if the world is running out of water and food, I think we have other greater concerns than wondering if Coke will remain profitable. Lastly, Coca-Cola is a well-established beverage company that has a $247 billion market cap. They've already expanded essentially everywhere and have likely already seen the lion's share of their growth in the past, which we'll confirm later in this video as we look at their revenue growth. Now I'll compare Coke to another similar business to see if we may be better suited investing in a competitor instead. I think the only other noteworthy competitor is Pepsi, as they operate in the same regions as Coke, they sell comparable products, and they buy out the up-and-coming drink producers, just like Coke does. Although Coke has a more substantial international presence, as we can see here from Pepsi's annual report, with 68% of their net income coming from the US, as compared to Coke's 34% of net income coming from North America. Additionally, Pepsi sells lots of snack items while Coke is a beverage business. In short, Coke is a one-of-a-kind beverage business at this scale. Now we'll check out the most meaningful fundamental metrics for analyzing a business, starting with revenue. I like to use 5 years of data because it gives a relevant picture of company performance and overall trend. Coke has grown their revenue from $34.3 billion in 2018 to $45 billion using their trailing 12 months earnings, which is a compound annual growth rate of 4.8%. I wanted to compare this growth rate to some of Coke's peers or other potential stocks I may not have initially considered, so I created a screen in TD Ameritrade where I filtered by sector, industry, and subsector, which were consumer staples, beverages, and soft drinks. I further narrowed the screen by market cap, looking for companies above $2 billion because we want to compare businesses at a similar scale to Coke. Finally, I filtered by companies that pay a dividend and that had revenue growth over the past 5 years. We end up with a bunch of Coca Cola partners and subsidiaries, and the only companies we have to compare to are Pepsi and Keurig Dr. Pepper. But I wondered if Keurig Dr. Pepper had as much international presence as Coke or Pepsi. So I went to Keurig's 10K and discovered that only 11% of their revenue is internationally derived. So Pepsi really is the only other similar competitor. Pepsi's revenue growth was 6.3% over the past 5 years, so Coca-Cola is slightly lagging compared to Pepsi. So Coke gets a negative rating in revenue. Next, we have net income, which grew from $6.4 billion in 2018 to $10.8 billion in the trailing 12 months, a CAGR of 9.5%. Comparing that to Pepsi, whose net income declined by a CAGR of 6.6%, Coke wins out in terms of net income growth and gets a positive rating. Although Pepsi's net income was unusually high in 2018, making their growth appear much lower than it would have if we were to exclude 2018 from our growth rate calculation. Here we have Coke's free cash flow, which grew from 8.7% from 2018 to the trailing 12 months, while Pepsi's free cash flow increased by only 2.2%. So Coke wins this category by a significant margin and gets a positive rating. Here we have shares outstanding, which is one of my favorite metrics, as it is a telltale sign of financial wellness, generally speaking. Coke has grown their shares outstanding by a rate of 0.2% from 2018 to today, and Pepsi's share count has declined by 0.5% over the same period. But neither of their share counts changed much, so I'm giving Coke a neutral rating here. Coke's total liabilities grew from $64.2 billion in 2018 to $69.8 billion today, a CAGR of 1.5%. Pepsi's total liabilities grew from $63 billion to $81 billion, a CAGR of 4.5%, so Coke wins by a landslide. Next, we have cash and short-term investments, which in short is a far more useful metric than so-called assets. Coke shrunk their cash by negative 0.75% from 2018 to today, going from $16.1 billion to $15.4 billion, compared to Pepsi, who shrunk their cash by negative 1.1%, going from $11 billion to $10.3 billion. So Coke marginally wins in terms of maintaining their cash. Now we'll subtract Coke's cash from their liabilities to get a true debt and compare that to net income. Coke's total liabilities are currently $69.7 billion, minus their cash of $15.4 billion, gives us true debt of $54.3 billion, which is 5 times their trailing 12 months net income. Pepsi's total liabilities are currently $81 billion, minus $10.2 in cash. We get $70.7 billion, which is 8.5 times their trailing 12 months net income. So Coke has a much stronger balance sheet than Pepsi and gets a positive rating in terms of liabilities compared to net income. And this level of debt is a red flag for potential Pepsi buyers. Since both these companies appeal to dividend investors, we'll analyze the state and trend of each of their dividends. First off, Coke has been consistently growing their dividends for 60 consecutive years, and Pepsi has been growing their dividends for 50 consecutive years. But I think payout ratio is a better metric for determining the sustainability of a dividend. This makes me think of weightlifting when I hear people say things like, I used to be able to bench press 500 pounds 30 years ago, and I wonder, how strong are you now? So let's look at their dividend payout ratio trend. From 2018 to the trailing 12 months, Coke's payout ratio was 103% of their net income, and in 2022 it was 72%. So the payout trend is moving in a favorable direction. Pepsi's payout ratio in 2018 was 39% and is currently 79%. Although 2018 was an unusual year of prosperity and their normal payout ratio is 74.8% over the last 4 years. Coke's 5-year average payout ratio is 82.9% and Pepsi's is 68.9%. This tells me that Pepsi seems to be attempting to maintain a relatively low payout ratio while accruing substantial debt to pay their dividends. Now let's look at the results of these underlying dividend metrics. Coke's 5-year dividend CAGR is 3.4%, while Pepsi's is 6.9%. But remember, Pepsi is piling on debt, which will have to be repaid at some time, and Coke's dividend growth is more aligned with their net income and balance sheet. Coke's current dividend yield is 3.2%, which is 5.1% higher than their 5-year average yield of 3%. Pepsi's current dividend yield is 2.9%, while their 5-year average is 2.75%, a difference of 5.1%. In summary of all these dividend metrics, Coke is losing in terms of dividend payout ratio and dividend growth. But Pepsi doesn't win either, as they seem to be using debt to inflate their dividend metrics at the cost of their balance sheet. So I'll give Coke a neutral rating here. Now we'll go over some fundamental metrics related to price, starting with the price to earnings ratio. Here we have the PE ratio for Coke and Pepsi graphed over 3 years, since the 5-year data doesn't scale correctly, and we want to compare based on current PE ratios anyway. Coke is currently trading at a PE of 23, while Pepsi is trading at a PE of 28, making Coke 17% cheaper than Pepsi currently. So Coke gets a positive rating in terms of valuation, as it is trading at a lower PE than Pepsi. Before we go into technical analysis, we'll finish this segment with the total return for each company over 5 years. Coke's 5-year total return is 36%, while Pepsi is 68%, which indicates to me that Coke is undervalued while Pepsi is overvalued. In summary of the fundamental analysis, I think Coke wins, and here's a summary of the ratings I created. Here we see a 5-year price chart for Coke, and the first aspect of the chart to observe is the trend direction. In this case, we're looking for an uptrend, which Coke satisfies for this time frame. The next tool I like to utilize and determine value with is the standard deviation channel, which is used to determine how far a price is from average, indicated by the center yellow line, which is the projected average price based on historical data. Coke is currently 9.5% below the 5-year average, which is a decent degree of discount based on its historical price variance. The next technical tool I use is standard support and resistance levels. Coke recently bounced off a prominent support level around $52 and was rejected by a resistance level around $57.50. Either of these price levels will likely be where the next significant price action occurs. Lastly, I used the Relative Strength Index, or RSI, which is graphed at the bottom here. It recently indicated a good potential buying opportunity with this green arrow and indicates it is still a relatively favorable time to buy the stock for this time frame, as the white line is currently closer to the bottom of the channel, although value seems to be slipping away quickly. That concludes my analysis of Coke. Let me know if you think I missed anything, and maybe I'll implement it into the next video. If you want to help support my sparkling water fund, hit the like button. If you like this style of analysis, here are some other videos that could be informative.
Not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.